Hello everyone and welcome to the Tax Gate. Today we are going to discuss one of the most important tax topics both accounting and tax professional would care about, which is deferred tax. So let's get started. Accounting profits are calculated based on the accounting standards. However, taxable profits are calculated following tax laws. The difference between both of them should trigger the deferred tax. So deferred tax would close the gap between the income tax estimated according to the company's accounting profits and the profits calculated according to the tax laws. Good. So, how it is created? Let's understand together. So just to simplify, upon calculating the company's income tax amount, normally we start with company's accounting profits, and then some specific adjustments are made as follows. Items added back to the company's accounting profits and items deducted from company's accounting profits, enabling us to finally reach the taxable profits. Well, those adjustments would include either permanent differences or temporary differences, and here we should highlight that only temporary differences should trigger deferred tax. Well, so we have discussed the deferred tax definition and how it is triggered, and now let's move to the types of deferred tax. Deferred tax would be categorized as follows: deferred tax assets and deferred tax liabilities. So for deferred tax assets, it would be qualified as taxes paid in advance, however it will be used to reduce income tax liabilities in the future. So it is all about the timing difference between booking profit from accounting perspective and tax point of view. Let's provide example. Talking about provisions. From accounting perspective, it should reduce the company's profits, however tax-wise, normally provisions are added back to the taxable pool. So the company would pay income tax against the provisions created for the time being. However, once this provision is utilized or being no longer required in a future period, then the related tax would reduce the tax liabilities of that period. A deferred tax asset can be considered also against tax losses that are carried over to a new accounting period. Well, that for the deferred tax asset. For deferred tax liability, it is the tax pending tax amount that will be paid in the future. Let's discuss the depreciation as example. Normally tax depreciation is a deductible tax expense and it would be higher than the accounting depreciation. Accordingly, such would reduce the company's income tax amount temporarily to be paid in a future filing period once the asset is fully depreciated from tax perspective. And with this, we came to the end of this video trying to provide a quick overview of one of the most common tax topics, the deferred tax. Like and subscribe if you would like to see more videos, and thanks for watching TaxGate.